Hello again, I'm Aaron Johnson, financial advisor with the Dwayne Johnson Group and Bridger Financial Services. It's hard to believe that we're 3 quarters through the year already, and honestly, although it's been painful at times this year, the markets have rewarded us in the first half of the year. Make no mistakes, there are still challenges ahead, but there have been challenges all year and the markets have persevered. Heading into the home stretch, I do not see anything changing and look for markets to finish the year on a positive note, but mainly due to the growth that we've already had this year. So let's take a look at the third quarter and then talk about what we can expect for the rest of 2023 to look like. The momentum from the second quarter carried over from July, which was a good month for markets, despite the Fed raising rates by a quarter point after pausing in June, only to resume raising rates again as we ended July. The July increase took rates to their highest levels in more than 22 years. Markets shrugged off the increase at first, viewing it as some last-minute window dressing before a Fed pause. Then markets settled in and began to speculate when the actual rate cuts would begin. August arrived and we began to see the consumer price index tick up from 3 to 3.2% as prices began to rise again. Then we got Fitch's downgrade of U.S. debt, and that was in response to the debt ceiling fallout. Just a quick side note, the video that I did right before this is on the debt ceiling and what it means for Americans, so check that out. The price of gas also started to move up as foreign oil producers and threatening summer storms began to constrict supplies. Gross domestic product and also accelerated in the third quarter. The initial reading was at 2.4%, but was revised down to 2.1%, roughly in line with where it came in at the first quarter at the 2% mark. The 10-year Treasury yield, which is a pretty good indicator of market sentiment, which had briefly just passed the 4% level in early July, quickly went above the 4% mark once more at the beginning of August and has remained above that psychologically important barrier ever since then. Markets tried to make the best of things, even accepting that the Fed was not quite done. They priced in another Fed hike before the year was out, but paradoxically still expected a chance of a rate cut in January of 2024. The Fed rate hikes in September and are expected to do basically the same the final 2 meetings, is pause those rates. Inflation ticked up further in August to 3.7%, which rattled the market's preferred narrative. Gas prices, once again, are the primary driver for that increase. The record high inflation we saw from shutdowns and market supply chain issues has mostly been squeezed out. But driving inflation down from that 3-4% level is going to be difficult. With August CPI increasing, concerns began to mount that the Fed will have to keep rates where they are and perhaps even one more rate hike before the year is out. The problem with that is higher rates will not have an impact on energy prices. That needs to be a policy shift on the part of the current administration. And so as long as gas prices remain volatile and elevated, these costs are going to be passed on to consumers via higher prices. Another component of inflation continues to be wage growth, with employers having to pay more to hire and to just keep workers due to low unemployment rates. People have more money to spend and they're paying higher prices. Stimulus money and savings are largely gone, and those that are not getting paid more are running up credit card debt. The consumer is spending and keeping the economy going, but as August rolled into September, signs of weakness again began to appear and the markets began to fret. We had a lackluster August and September, and it wasn't great either that the 10-year Treasury yield remained elevated. In addition, concerns that the Fed would have to do more to help tame inflation crept into the daily dialogue. The problem with expectations that the Fed may need to do more, which, by the way, was not fully priced in yet, is that moving inflation from 4% to the Fed's desired 2% level is that the Fed will induce a recession. So recessionary fears began to dominate the latter half of the third quarter, and markets kind of floundered from one data point to another, trying to find a path forward. That said, we're still having a decent year, and it's logical for markets to consolidate or kind of pull back after a strong run like we had in the second quarter. Remember, we had hurdles in the first half of the year, like the mini banking crisis, debt ceiling crisis, and now we have a looming government shutdown, auto worker strike, we had the writers' strike, and worries about tensions in Israel with Hamas going on now, and worries about the Fed doing too much. So there's always going to be something to be concerned about. And that doesn't mean that we need to be sitting on our hands either. Like I said, I'm optimistic that the year will end on a positive note. We'll be back in 3 months to do a recap of the fourth quarter and of the year as a whole. The last quarter will likely test our patience, but we do believe that markets will overcome and forge ahead just like they always have. I am sure that there will be something unforeseen in the last 3 months of the year, especially as election season heats up the latter part of this year and into next year. This will be a time for attentiveness and alertness, not a time to just sit around and kind of watch the leaves fall. But remember, keep your goals and your time frames in mind. And as we're doing reviews with you, we'll make sure that you're still on track. Please reach out to us if you have any questions. Our number is 951-244-6702. We wish you a wonderful holiday season if we don't talk with you before then. Thank you very much for your business. We appreciate it, and have a great rest of the day.